daily market wrap for Thursday, 18th of June. Chris is under the weather, so I'll be flying solo today. For once, a welcome change. We're not going to be talking about the Iran conflict too much today, thankfully. Nothing major has happened since the Memorandum of Understanding was agreed upon on Tuesday. Now that's slated to be signed tomorrow, so we'll see if anything happens between now and then. But for now, markets haven't focused on it. The big news dominating the markets was the latest US Fed rate decision. It's the first decision by the new chair, Kevin Warsh, and they did hold the current rate, but what was interesting and a big change was the language in the associated statement and press conference. Typically, they had dovish language in their messaging previously, which indicated they were looking to cut rates in the future. They've basically stripped that out and taken a more hawkish tone, indicating they're likely to raise rates moving forward. The market's expecting another rate rise later this year, and I think they've got a probability of 2 by next March. So that has been a big shift in the stance of the Fed. What's happened is the US dollar has strengthened as a result across the board and led to some pretty big moves in the markets overnight, which we'll have a look at shortly. Elsewhere, the UK also released their latest inflation figures. Now, Core CPI was expected to go up 20 basis points, which is their equivalent of the trimmed mean inflation the RBA uses. It actually came in a little bit softer than that. It still rose, but only rose 10 basis points to 2.6%. The market wasn't expecting this. It was a little bit bearish for the pound. It did sort of claw back a few of the losses, particularly against the euro, but the softer surprise did definitely have a bearish effect on the pound, so that's worth noting. Looking ahead today, the UK will also follow with their own rate decision. They're also expected to hold at their current level of 3.75%. What the soft inflation data, whether that changes their messaging and their forward guidance, we'll wait and see, but that's what traders are going to pay more attention to than the decision itself. And then Switzerland are also going to release their interest rate again. It's currently at 0%, expected to hold at 0%, and the franc will be largely unaffected by the news unless we get something really shocking out of Switzerland. So when we look at the big movers, you can see silver had a big 3% drop. Gold also had a drop yesterday, and that's squarely from the rate decision out of the Fed. Now, while they didn't actually change their rates, it was the change in messaging, the forward guidance. So changing the tone from dovish to hawkish, you can see the effect it's had. Why that happens is the US dollar strengthens, bond yields have also strengthened, so that the two-year yield, which tracks closely the short-term rate policy, that rose 16 basis points. The 10-year yield, which is the key benchmark, that also rose. So it's obviously silver and gold don't earn yields. Investors will shift into the yield-earning assets like bonds. That explains what happened there. We'll see if it recovers at all today, but that was the reason for the sharp fall a couple of hours ago. And again, equities also fell off. So this is the S&P, the big index out of the US, that also had nearly a 1% drop. Again, rising interest rates or expectations of rising rates, that actually brings down the valuation of companies as it increases the discounts for the forward valuations. It also means borrowing costs will increase, so it's going to be more expensive to get debt. So yeah, those have a negative effect on equities. And then the euro dollar, again, very similar to what's happened in the precious metals, in the equities. It's the divergence, well, the change in the rate messaging. Obviously, the ECB, which controls the euro rate, they raised the other week, but now with the USD looking to follow along those lines, took off some of the gains they've had, so they dropped 1% as well. One chart I don't think we have looked at yet is the US dollar index, or the USDX. You can see it had a massive spike yesterday. This is basically an indicator of the relative strength of the dollar. So what this index is looking at basically the US purchasing power against 6 major currencies. Is based off the exchange rates of those currencies, with 100 being the baseline. So if the US dollar index is rising, that means the American dollar is gaining strength. If it's falling, it's weakening. So 100 is the baseline, and the rate decision yesterday and the language around it, that's pushed it above that 100 baseline. So the US dollar is gaining strength, and this sort of highlights how stark that increase was. Chart of the day, I sort of touched on it in yesterday's report, but sort of worth highlighting again. This is looking at the US yen and its performance this year. That horizontal blue line is sitting at 160. Does anyone remember the significance of that 160 level looking at the US yen pair? Nope. Blank faces. That indicates historically when the Bank of Japan, which is the central bank over there, they've stepped in to assist the yen and make sure it holds its value. So you can see there was a massive drop at the end of April when it was holding above that 160, and that's when the Bank of Japan started intervening in the currency markets to bring that price right down. But you can see since then it's sort of been tracking up despite that intervention. The Bank of Japan raised their rates earlier this week. It's now at the highest level since 1995, which is significant. Didn't really have much effect on the yen, and now with the tone changing around the US dollar, it's going to be really interesting to see over the next sort of short term what happens, whether the BOJ does need to step in again and bring that price down, so we could see some moves moving forward.
Why did the rate rise for the yen not do anything to the currency?
Again, it's still comparative to the rest of the world. Very low, 1%. The US is in the high 3s, Australia's in the low 4s, the euro is 2.25. So comparatively, it's still very low. There's still the carry trade existing. Also, markets are sort of, even though there was hawkish messaging, markets are sceptical how much room they actually have to raise rates, even if they want to. Raising it too much could put too much pressure on the economy. They don't want to go into recession, so it's a very fine balancing act. And obviously, the markets are expecting 2 hikes moving forward in the US dollar, so obviously a lot more tightening possible on their side, so they're the main reasons. And then, article of the day is just looking at the rate decision. I know it's not the most interesting topic, interest rates, but it's a key driver of the markets. This will kind of break down what happened with the decision. Obviously, it's the first one in a new regime, so it will show what's changed with this regime, how they're going about it, and what might be happening moving forward. Thank you very much. Have a good day.